Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Hey, how you going? Phil Tarrant, host of the Smart Property Investment Show. Welcome back for this special series on the Property Investment Podcast Network of the Fast 50 report for 2024. This is where to put your money now for the best capital growth in 2024, recently unveiled on the Smart Property Investment Podcast Network. You've probably seen this report everywhere. It's gained a lot of attention, a lot of interest from people who are looking to shape investment decisions over the coming period. And just to recap, this is a curation of the knowledge, information, years of expertise and experience of the brightest minds in property investment. We've gone to them, they've given us recommendations, we've looked for commonality between them, overlaid with data to get the Fast 50. This is a list of some of the best performing properties, according to these people, for investment over the next period, shortlisted down from about 180 initially. So a lot of good properties in here at all different price points to suit most buying needs and different strategies connected with it. The report partnered by good friends over at Pure Property Investment. We're breaking it down, one podcast a month, one podcast a day for the coming 6 days, so you can get some insights into how we're viewing this report and how you can use it. You should have already tuned into a couple of them. Today, I want to get some sense around budget. So investing across the spread from $1 million+ markets down to more affordable markets in parts of Australia. There's something in this for everyone. And as I spoke about earlier on with this particular ranking and report, we did actually have them in order initially, and I've decided not to do that because I thought it was irrelevant, because certain people can only buy and invest in certain price points, and a lot of that's going to be based on your financial capacity and your strategy. So here is 50 of the best locations to put your money today. There's also some other ones, and we'll chat about it, that didn't actually make the list, which we also think are pretty good. But we're going to break down investing across the spread. Joining him in the studio is the CEO of Pure Property Investment, the partner for the Fast 50 report, Paul Glossop. Welcome back. How's things?
Very well, mate. Very well. We've sort of excited because of the fact that we've sort of broken down really the back of what this Fast 50 guide is. But now, to your point in the intro, mate, is that there's going to be listeners out there who really have a limited budget and think, well, what can I do if there's anything in there for me? And conversely to that is people thinking, well, I'm not too fussed about the yield side of things. I'm more interested in the growth side of things. Budget's not my issue. Where can I invest and what should I investing in? And that's what we're going to get stuck into today.
Yeah, we are. And just to recap, this is houses.
Yep.
This is not units. So we're only using house data. And there might be people going, I only invest in units.
Yep.
Yeah, okay,
and we're not averse to them, but
yeah.
we did break down the last episode about, some of the things we'd look at and some of the things we'd probably exclude if we're looking at units.
And we also, there was some locations nominated by our expert panel, which had less than 50 sales annually. And we said, look, let's not include them for the purpose of this. So we're looking at aggregate scale. We spoke about the last time we got together, Paul, around this notion of timing is right. And the fact that I haven't heard of half of these suburbs beforehand. Yep. So it's about getting into the market at the right time to ride that wave of growth. And our experts have put together their sentiments and their recommendations, and we've interpreted that to create the Fast 50. But property investment, I'm conscious that sometimes smart property investment might do this. We often, and it's deliberate, right? Because it's at the center of the bell curve, right? Most Australian investors probably invest in a very similar bracket. But there is outliers to that. So there's some investors that only invest in properties well over $1 million. But by and large, and it follows, prices in Australia, most investors sort of operate in the middle of that bell curve. And therefore, a lot of our commentary and focus on the Smart Property Investment Show is around how do you invest in those markets. But Paul, looking at the Fast 50 report, the most affordable, I don't want to say cheapest, because it's probably cheap sounds bad.
Yep.
So, which isn't the case. The most affordable location for the median price, it's in Western Australia. It's a metro location. What do you reckon it is?
I would go out on a limb and say it's possibly, that's in the report, I'd say it might be either Armidale, Gosnells, Mandurah. There's probably those three.
All right. Well, I'll score you pretty well there. Armidale.
There you go.
Armidale at 305,000 for a median. Mandurah is, and this is all live, and to our people watching this on the video, you see how it's happening, is 350 and Gosnell's is 370.
There you go.
There you go. So, and you obviously invest in those locations because you know the price points.
Yeah. But I mean, we spoke about this off air too. We literally went through a large portion of that, and you were sort of rattling to me. We're trying to categorize regional versus metro, and yes, granted, there's a number of suburbs in there that we didn't contribute, but we were trying to ascertain which one was clinically or defined as regional versus metro. And I think one thing you do when you do this every day is you get pretty good at understanding markets that even if you're not investing in them, you get pretty close to the source of the data because you probably looked at the info at some stage.
What's that? What was that advert when all you do is conveyancing? You get really good at it.
Good at it.
One of the great
Paul
ads.
Denny conveyancing.
Paul Denny conveyancing.
Jeez, that's a free plug. Jeez, I tell you what, they want to come on the show after that one.
They still going?
Oh, man, I haven't heard it. Granted, I do listen to a lot of AM radio, and I don't hear a lot of ads, but I reckon they'd be going. That seemed too well organised. It was such a good, poignant point. It was like, if I want to convey and say it, he sounds like the most cut and dry, boring person who I want to convey.
Yeah, and
I don't want any humour out of him.
Maybe
get him on the show.
Maybe you should hijack that. So
when all you do is property.
When all you do is buy property, you get very good at it. Paul Glossop, pure property investment.
Oh, might have to check if there's a trademark against it.
That's verbal. That's a compliment. It's a good advert. So the bottom rung of prices, Paul, sort of low 300s. And for those people saying, what? You could still buy in a capital city for under 300,000? No way.
Yep.
What's that from?
I think it's coming to a bit. It'll come later on.
And at the top end, 1.8 million. Clayfield.
Yep.
Queensland.
Yep.
You know Clayfield?
Clayfield, nice suburb, leafy suburb of Brisbane. Yeah,
so you got Clayfield, places like Leppington. We spoke about this and I think that's been
acreage mixed,
skewed.
Yeah.
Hamilton.
Another nice suburb of Brisbane.
Oran Park,
Newcastle. Sorry,
Hamilton. Oran Park again, probably acreage sales for development. Maybe Oran Park's completely.
I couldn't be categorising Oran Park into. I mean, it's not a suburb that we're buying in, but you wouldn't be. I personally wouldn't be ploughing $1 million into a house and land package in Oran Park, which is what they are for that matter.
Yeah, and I think that's where a lot of mortgage stress is happening. Actually, first home buyers who have bought 100%. Out and that belt through
90%
the Ponds, Rouse Hill. I read some report that 100% of people in areas like the Ponds and it says this. Watch out. Probably was. but that's sort of that area out through like not Ropes Crossing. The Ponds and
Box Hill out there, right across, over.
Where the new train line has gone out, saying 100% of people are mortgage stressed, right? And these are all first-time buyers who have bought these big places and now getting the realisation of normal interest rates, right? So anyway, so there's something in here for everyone, but I'll quickly break it down. This is on the fly. So there is 12 locations that are in the $300,000 bracket, Paul.
Yep.
There is 14 locations in the $400,000 bracket.
When you say 400,000, 400 to 500,000?
Yep. Yeah, so with a 4 in the number.
Yep.
There is 14 locations in the $500,000 bracket, as in a 5 in the number.
Yep.
So from 596 down to 500,000. There is 5 in the 6,000 bracket. There's 1 in the 7,000, and the remainder of them, 4 of them, are in the $1 million bracket. So you got nothing there really between 700,000 and $1 million.
Yeah, and that should really excite anyone who's already downloaded this guide to say, well, what's in it for me? Because within that, and we will break down, not only the price point, but also the yield curve and the actual median weekly rents, etc. Because if you're a little bit conscious of cash flow, or you're very conscious of cash flow, or you're not concerned at all about cash flow, realistically, there's going to be a bell curve there of the higher price points are going to dictate the lower yields and vice versa. But it's not to say that the lower price are just in this report because of the yield. And going back to methodology, correct me if I'm wrong, Phil, but I think only 5% of the overall actual weighting came down to the actual gross rental yield amount. Yeah,
so we sliced and diced it. So the basis of it, and go and tune into the initial podcast on this, but largely the report was driven by the recommendations for experts.
Yep.
And then we've tried to turn those 183 recommended suburbs into 50.
Yeah.
So we overlaid it with data, and we've leveraged median quarterly growth and average annual growth as the sort of primary mechanisms to shape it. Sorry, median quarterly growth and 12-month growth, so the primary mechanisms to shape it. And then we've applied also average annual growth and gross rental yield. But
Yep.
the gross rental yield is marginal to influence.
Yes.
It would have just maybe swapped the bottom 2 or 3
Correct.
locations around it. But the idea being that we would expect there to be a good gross rental yield, but pretty much all over Australia right now, unless you're in markets,
and it's getting better.
It's going to be good gross rental yields
Yeah.
everywhere because of the shortage of property.
And I think to your point, mate, that it's a very key part here to understand is that gross rental yield in isolation means nothing, because we've gone from, if you talked about gross rental yield this time last year of 5% versus where we are now, that's a difference of cash flow positive to cash flow negative, and the yields, gross rental yield, stayed exactly the same. So realistically, you've got to apply that to your cost of money, the cost of actually the actual holding that asset in that particular state. There's different property management fees, different insurance, different council rates, different water rates, et cetera, et cetera. I think probably the other big thing that I'd like to mention in there too is that going back to the Fast 50 was initially 178 markets, and this same filter was applied
Sorry,
to...
is it 183, 178? Hang on, I'm going to tell you exactly. I keep getting the number wrong. You're correct, 178.
There you go.
I've got the number wrong.
That's
178.
But in saying that, I mean, this is the thing too, is that, you talk about the influence of 5% of this weighting was yield, and you realize that it didn't really influence this list. So you got to be really comfortable with the fact that this list isn't put together for those who are not worried about yield or very worried about yield. This isn't just telling you where to get the best yield.
Yeah.
It's a factor in there, but you'll also see that there is actually quite a lot of these markets that have very, very tasty, and I use that in a bit of a, I guess, an expressionistic term, but a very strong yield when you look at it from an overall perspective, but remembering that's not why these markets have been recommended.
Yeah, and remember, this is 50 of the original list also. So there is the other list, and we're going to go through some of them as well, because, and you'll find that there is more properties that are at sort of more of the average of the medians outside of that list. So this is, it's a really interesting dynamic how this worked out, and that's the secret list. If you want that, you can go and speak to Paul, who'll tell you.
I do have access to the
you
secret
do
list.
have
That's the black book list.
Glenn, you must have watched Glengarry Glen Ross. Yeah.
The leads a week.
Got the leads. But it's an interesting dynamic. So newsflash to all those people complaining about housing affordability and not being able to get into the property market, you can buy property for $300,000. You can buy a house for $300,000, $305,000. Close. How far is Armidale?
Yep.
WA to Perth CBD.
If you're driving, 30 minutes, 45 minutes, somewhere in that bracket, depending on traffic.
Yeah. Okay. Yeah. So you can afford. So housing is affordable.
Housing is affordable in a market that's got more than 2 million people, that has got a relatively low amount of supply, that has got an unemployment rate sub 4%, and you've got yields north of 6%.
Yeah.
You can buy for $300,000 to $350,000.
So look, people tuning into this are property investors, so they want to buy those properties to put people into it.
Exactly.
But for those people who are sitting there also tuning into this, complaining about not being priced out of the Australian property market,
it's
you know what? If you're on an average salary, you can buy yourself that. So move to Western Australia, move to Perth. You know what? Maybe get a new job in the mines, and you have no problems affording that. And guess what? You'll probably, if you don't spend all your money on jet skis and utes, you'll probably buy an investment property as well.
Yeah, absolutely.
Topical.
And you go to the, you talk about that, and let's say you're a rent investor and you don't want to buy to live, and you're looking to buy and invest, and this is your first investment. You start to talk about, well, what would you actually need for a circa $300,000 to $400,000 property to get into the market? I know we talked about lenders' mortgage insurance a little bit in the previous episode, and talking about how far you'd have to go for a 10-12% deposit and closing costs. The reality is 50 or 60 grand will get you started in this list.
Cash money
or equity or a family guarantee, family pledge, any of that put together.
So that's getting really tactical, right? And look, we're not giving advice anyways. We're just socializing ideas to get started with. So, but if you want to be a rent investor, say you live in Sydney or Melbourne, you like the cosmopolitan life, your job is here, brilliant, stay there. Doesn't mean you need to be buying investment property where you live, right? Or rent. There is other locations, and what we're identifying here is a bracket of properties, all of them.
14, you said, I believe, of that $300,000 bracket. 14.
12. There's 12 in the $300,000 bracket, and of those, 2, 3, 4 in Queensland, 1 in South Australia, and the remainder in WA.
Answer me this, Phil, and hopefully you can do this on the fly, and apologies if this takes longer than what I assume, but out of that bracket of markets there, what has been the median quarterly growth on those markets? Are you able to average that out to give people an understanding? Because people are probably thinking, well, it's so cheap, it probably is not moving, that people are just buying them for cash flow.
Okay, sorry. There's 12 properties
Yep.
in the bracket of from 393,000 down to 305.
Okay, so 12 suburbs in that list, right
the
there.
spread of median quarterly growth.
Yep.
At the top end, 4.2%. At the bottom end, 0.7%.
And over the last 12 months on those same markets, so essentially we're saying that they're all growing over the last 3 months. Every single one of those suburbs has grown.
So the average, the median quarterly, the 12-month growth for those same properties in that bracket, right? And this will get people scratching their heads. The highest, 26.8%.
Mm-hmm.
There's another, which is Avenel Heights.
Avenel Heights, yeah.
You've got Mount Gambier at 25%.
Yep.
You've got Warwick, Queensland, at 24%. You've got Churchill, Victoria at 20.7%. Then you've got all the other ones are within the 10%, mid to high 10%.
Which you're taking every day of the week.
Which you take every day of the week. So we're talking about these prices, right? So let's say, for example, Mount Gambier, right? South Australia. Okay, median price now is $375. That's grown by 25% in the last year.
Yep.
So the median was a lot lower 12 months ago. So already those people that are in that market have got a 25% uplift.
Correct.
Which ain't bad going. So same example there in Mount Gambier, 2.7% is its quarterly growth. So last quarter.
Yep.
And average annual growth, 5.3%.
There you go. Yep.
So it's in its ascendancy.
Yeah. Yep.
It's in its ascendancy. And that's what we're trying to identify. Average or median price, 375, average rent, 360, 5% yield.
So 5% yield. Is that just for Mount Gambier, or is that in that bracket?
That's Mount Gambier.
And within that bracket, I mean, what are some of the averages of yields? I'm assuming that the yields are probably ranging between 5 and mid 6% as well.
Yeah, mate, you've nailed that completely.
Yep.
So top end in yield is 6.5%, and the bottom is 5%.
Yep.
So 5s and 6s.
So you're talking plus or minus, $2, $3, $4,000 a year on a 90% loan to value ratio debt if you're factoring in 25% running costs of that particular property. So the really important thing there, I think, going back to what I was saying earlier, is that if you're thinking this is your entry level, and going back to your example earlier, Phil, of your first properties, and if I said to you, hey Phil, over your journey of the last decade plus of buying property, and you've bought property as cheap as a couple $100,000 and as expensive as multiple millions of dollars and everything in between, it's actually increased over time because your ability to finance and your equity and your cash flow has increased. But would you do it differently? Well, you probably couldn't do it differently.
No, you wouldn't.
You can't.
If I was starting again, I would have done exactly what I did 11, 12 years ago. It would just be in a different state.
Yeah, because you're starting now versus you start. And this is exactly what this report is saying. If you were starting 10 years ago, this report ideally is going to give you the guidance to say, here's what you're doing when you're starting. Now, I think it's not just telling you how to start, but it's also telling you if you've been in the game 5 years, 10 years, and you've got some runs on the board and you think, okay, I've got a bit more cash. I don't want more assets. I just want better quality and less of them. Then there's also, and we'll go through that data as well, is that maybe they're not so cash flow in mind. But I think we've just talked about, we've isolated 12 markets in the 3 to 400K band. We've talked about the fact that you're probably going to need 50 or 60 grand to get into those.
To break
markets.
that down quickly, so it's 20%. So use the number of what's really easy. Use a number of what's an easy number? 350, right?
Yep. So 350 grand purchase price.
So there's one here. So 350. Let's use this as an example. This is Mandurah.
Yep.
6210 WA, and geographically south of
Perth on the coastline.
An hour or so.
Yep. Train line still straight to Perth, a couple of Ks.
So we've got that as regional.
Yep.
It's an argument.
It's kind of
so
for people who are, I think if you're Melbourne based, you'd probably say it's the equivalent of like Geelong. If you're Sydney based, it's the equivalent of Wollongong / Central Coast distance, etc.
Okay, so that's had 268 property sales in the last year. Median quarterly growth 2.9%. Average annual growth 10-year 2.3.
Yep.
Last 12 months 12.9%. It's got a yield of 5.9. Average rent $400, like all day long with that stuff, right? And you're going to be going, wow, why is everything so, like, why is the growth so lackluster in Western Australia over the last 10 years? Well, the reason why is the market hasn't moved.
Exactly. If you
so people are buying properties today for what they sold 10 plus years ago.
And this is where we probably pay a pure property investment. We pay for some data, gives us access to 20 and 30 year geographics as well. And when we start to think, okay, well, yeah, between 2013 and 2023, you look at that, they're a bit over 2% average annual growth. If you go between 2003 and 2013, that market more than tripled.
Yeah.
So then you say, well, yeah, that is obviously the danger of markets growing so aggressively and so quickly. Is that
nothing happened?
So,
but again, and the last podcast we recorded yesterday, it came out, was all about timing.
Exactly.
So timing that market,
Timing
like
is
if you
absolutely
bought
vital.
at the top, like if you bought at the start of that run, happy days. If you bought at the end of that run,
here you
not
are.
so
It's the
happy
same
days.
as the Docklands example we used a couple of podcasts prior. If you bought the end of the run, it's the equivalent of buying that at the end of the run. You've got to find the timing, but then you say, okay, well, I don't just want to time it, but then I can allow myself to get time in the market, and then you overlay cash flow, which gives you the ability to do all that.
Yeah. So let's use this 350. So let's practical for those people who might be rent investing or starting investing. They've got a principal as a residence. They might have some equity in it. They've had it for a while. They're sitting on Melbourne market and they're going, "What am I going to start doing this?" I'll start at the more affordable end. Let's talk cash money.
So $350,000. If I was to talk about realistic minimums as far as what you need to get into it, I would probably say 10% deposit, 5% closing costs. That accounts for things like stamp duty, if you're using a buyer's agent, for lender's mortgage insurance, solicitor's fees, etc. If I'm looking at that, then I'm going to talk about, really simply, $350,000. 5% of that is about, let's call it 20 grand. I'll roll that up to about 20 grand. And then I've also got my 10% deposit. So I've got $35,000 is my 10% deposit plus 20 grand for my closing costs, establishment fees,
so closing costs. So you're saying it's a 10% down.
10% down.
So 90% LVR, which means you need lender's mortgage insurance, which you price in, and this is
stamp
using
duty.
an organisation like yourself.
Yep, correct. So this is price in a buyer's agent. This will price in stamp duty, closing costs. So I've factored in there about $55,000 to go and buy that property.
Okay.
To go and buy the average property in Mandurah today.
Only need, it's a lot of money, obviously, but
But I mean, do your math on, if you, like you said, if someone owns a property and they've got maybe $100,000 in equity in there, and then we talked about lender's mortgage insurance, and people think, but if I did that, then I have to get lender's mortgage insurance.
And it goes back to timing. We spoke about time before, and you mentioned last time we got together when we were talking about timing was, if you miss a year of growth,
it was 80 grand.
This was 80 grand based
over 15 years
on a 15
versus
year
14 years. 80 grand.
So this timing meets the bracket you operate within. Now, this is good for people starting off, but I would imagine and I probably as I sort of process this in a live environment, like I'm sort of the opinion with my own personal business. I'm going, I don't really want to be buying that stuff anymore. I don't want to be buying that stuff anymore. But I sit there and I think about it and I go, maybe, but I reckon, like a lot of people, and hence the reason why we have diversity in this ranking, I'm probably a bracket or two above that these days.
Yeah, I'd agree with that.
I've done that, and it's been hugely beneficial. You've done that. You don't hold a lot of assets like this anymore. Do you buy this stuff personally anymore?
I've just bought. I've actually personally just bought one in this bracket, in this portfolio, intentionally in my super fund, and probably more so because I want to put my money where my mouth is. So I've actually personally invested in one of these markets in the top 50 guide or fast 50
well,
guide.
You give Paul a call, he'll probably tell you where it is. He's not going to say. He won't tell me. But,
I won't tell you.
But there's other brackets here.
It's
so
in the guide.
In the guide, is it? Secret. Okay, so there's 14 locations, which start with a 4. So 419 to 497. Now, this changes geographically some of the areas you operate within. They're still heavily skewed towards WA and Queensland and a couple of South Australia. Horses for courses. I guess the question is, if you have greater buying capacity, why should you be investing in brackets above those more affordable brackets inside of the Fast 50?
It's a good question, Phil, because I often talk, and I say this openly to my clients too, I often talk myself out of business with clients, and I'll expand on what I mean by that, is that you're a good example, Phil, where you've got a couple of different portfolios running, and they have different asset types in them, but you kind of, generally speaking, you're looking at it saying, well, I don't want more, I just want better. And sometimes you can get both, but a lot of the times, and probably predominantly for me, it's the person with the most property doesn't win the game.
No.
It's the person with the least amount of moving parts, with the best outcomes and the absolute best cash flow that they need to support it, wins the game typically in property. And that's what we're always trying to support. So if I have a client who, you've explained that you're probably a bit above needing to go down at 300 grand bracket, if we're talking, hey, look, you probably don't need 2 properties at 300 grand, you probably need 1 property at 500 to 600 grand because it'll do vast majority of that same lifting. And even if it gets the same outcome, you've got 1 less set of headaches. Sometimes you can also have a counter argument to that to say, if you've got 2 properties of 300 grand, one of them's vacant, then essentially you've got 50% vacancy.
Or in different markets, you get diversification.
Correct. And
there's
land tax thresholds, and there's a whole bunch of things we're going to do. And I don't want to dig too deep into that, but I am a big believer that every property is its own small business. And as an owner of multiple businesses, and likewise with yourself, they are work and they need attention. To do it correctly, they need attention. So I always am a big proponent to say, if you don't need more, let's go for less, but look for better.
Yeah, I was only this morning after I dropped my kids at school chatting with my wife, who you know, and I was just going, I just want to be less complicated. I need less complicated is good. And to your point, if every property is its own small business, you don't want 70 small businesses, right?
No.
You know, that's hard work.
It's
right?
hard work.
Or it's a business in itself running
Correct.
that, right?
Yep.
You actually need
and we know people who are in that space, and we know what,
like that.
and it's not ideal, in my opinion.
I don't have that many properties, but even like I get calls coming, just even while I've been recording, there's calls coming through, which I know are from property managers telling me to pay bills, or there's another problem, or
what do you want to do?
And I'm just, it sounds really, it's horrible, right? But I sit there and just go, it's just not that important. It's just not that important to me for me to worry about that yet. It becomes important when you know, they start yelling and screaming because I haven't paid for something that some tradies fixed. Like I've got one of the properties, you know, some tenants trashed it. I had to do an insurance claim. You know, I've just gone, well, what's the problem? I'll just speak to insurance and sort it out. It's all been sorted out. Now they want to get paid. Right? I think I've insured. I think I've received the money from the insurance company.
Now they're asking me.
They go with the money. I go, but I'm like, it's just not that important. You know, and that sounds really, really bad. So be careful, right? As a property investor, be careful what you wish for, because, you know, less is often more. But the point being, you got to start somewhere, Paul. Now, there's a whole nother bracket of properties here, you know, which is, you know, in this $500,000 bracket, you know, and they're going to be suitable for certain people, right? Then there's another bracket of $600,000. So, you know, you've got to download the report to have a look through this.
Absolutely.
Download the report to have a look through it.
That's absolutely crucial, because we could dissect every one of these brackets. And one thing I'd say is that it will be pretty obvious is that you will see that the higher price you go, the regression in the yield will become. And that's relatively simple to understand. We don't need to break that down. But I think if you're at the point where you're happy to invest in $600,000 assets or north of $1 million assets, you're likely already got a property or two in your portfolio. And in turn, you're probably also thinking a little bit more about less moving parts and higher growth, but you might also already have 1 or 2 of those $300,000 or $400,000 assets in your portfolio. And it's a walk before you can run, not just because that's all you could afford, but sometimes people just want to dip their toe in and just make sure that they buy an asset. It's still a good asset. It's still going to grow. And as we've seen, even in that 300 grand bracket, there's plenty of markets that are growing exponentially. They're still going to give good cash flow. They're still good quality, established freestanding houses on blocks of land within areas that have got great propensity for growth. You're not sacrificing those things by spending less. You might choose to say, I don't need 3 of those, as opposed to maybe 2 of the lower price point ones. But don't just necessarily think that because you're spending less, you get less. And conversely, you don't need more of the little ones, just if you think it's a game of, hey, I need 10 properties instead of $5 million in assets. There's a difference. And don't get caught up with that, because a lot of the time people are trying to sell you something you don't need.
Yeah, and some home truths for those people investing or looking to invest in property. When you're looking at brackets, don't compare your chapter 1 with someone else's chapter 10. Again, I've borrowed that.
Love it.
I've borrowed that from another property guy, Tom Panos, but it's absolutely true. Don't compare your chapter 1 with someone else's chapter 10 and number 2. And there's something, you know, I sort of, you know, thought a lot about strategic patience. Strategic, you got to be patient. Like strategically be patient in property, because we've shown, and the discussions of these podcasts and the Fast 50 report, you know, the time in the market will determine and dictate the growth that you have. You know, if you're looking for the immediacy of a sugar hit of growth, well, you're probably not investing in anywhere where the Fast 50 is.
No, exactly correct, mate. And I think the big point to reiterate here is that we talk about this being the Fast 50, where to put your money for the next year or so to really try to supercharge your equity position. But if you're buying a property for a year outcome in Australia in particular, with the the ingoing and outgoing expenses, it's far too risky and far too cost prohibitive to really invest for that shorter time frame. If we are speaking to clients at Pure Property Investment, we speak about a 7 to 10 year hold period as a minimum.
Yeah.
And I think if you can't have that horizon, and going back to the importance of what we're trying to do is that we're trying to get into a market that's going to give us above and beyond average growth to what the majority of the markets will have over the next 12, 24 months. But outside of that, it still isn't going to move the needle enough to justify the overall outcome and experience.
There you go. Well, if we've sort of discussed any themes here that people are unsure of or some concepts, they can just give you guys a call.
Absolutely. Yeah. Purepropertyinvestment.com. They can give us a call, 1300 98 5428. They can set up some time to chat with me directly at any stage to talk about anything in this Fast 50. They can even ask me where I've bought recently in my SMSF. Or talk about their own experiences and potentially what they're thinking or planning on doing.
Smartpropertyinvestment.com.au. Go and download the report now. Just go to the website. You'll be able to find it pretty quickly. Click on the link, download the report. Thanks for tuning in. We'll be back again tomorrow on this special series of the Fast 50 podcast series on the Property Investment Podcast channel. Thanks for tuning in. Hope that's valuable. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.